All right, we're back. Let's talk futures. Joining me live from the Chesapeake Bay area, Blu Putnam, Bayesian Edge. Blue, how are you?
I'm doing great this morning. Thank you.
Well, that's good. It's good to see you. I appreciate your time being with us today, man. But Chair Powell yesterday was just magnificent.
He was, and he made it clear the Fed's going to stay independent as long as he can. The last president to challenge the Fed's independence was Harry Truman, who wanted to have the Treasury Department take it over. And the person that stopped it was a guy named Eccles, who was on the board at the time, and they named the Fed building after Eccles.
Yeah,
So every
yeah.
time Powell walks into his office, he sees that name, and it's all about Fed independence.
Yeah, and from a realistic point of view, don't you think cooler heads would prevail before there was any shift that way?
Well, I mean, it requires legislation to change the Fed's charter, and
Yeah.
that's a hard process. But Jay Powell will, his term ends in 2026. I think it's May. Uh, and we'll get a new chairman, and we'll just see where we go from there. But some of the folks that are on President-elect Trump's transition committee, like Art Laffer, who was one part of the looking at the Fed, they understand a lot about Federal Reserve policy. So it's just not clear what'll happen.
Yeah. Well, so two things he said yesterday right off the bat, Chair Powell, during the press conference. He said the labor markets remain strong. That's number one. And then two, inflation has eased substantially. He basically said, hey, here's the dual mandate. Here's where we're at. You don't have to applaud. You don't have to applaud, but everything's looking good.
Yeah, he's checking both boxes, so he's in good shape.
Yeah, no, I think so. It was interesting too in his comments because in the actual press release, they omitted the reference, we have gained greater confidence in inflation moving substantially toward 2% target. So they removed that from the previous press release. Everybody saw that and got excited. But then Powell said during the press conference, the change in statement omitting confidence was not meant to convey anything about stickiness of inflation. So,
No, and it's actually typical is that once a certain degree of confidence has been clearly obtained, I mean, inflation is definitely lower, and it's below 3%. So you have to adjust the statements to reflect the new reality, and that's what they did.
yeah. Yeah. So anyway, I thought, yeah, I hear you, man. I'm glad you're thinking like me. That he was just really, really, really good yesterday. And it's funny too, though. The other thing seemed to be the election totally, totally overshadowed the FOMC meeting, right? We barely talked about it in the previous couple of weeks, and maybe that's a good thing.
It probably is a good thing, although I suspect you're going to talk about it in December. It'll
Yeah.
come back. But the Fed the policy is still restrictive, even with the rate cut, and there's room for more. But there's no question that the market thinks that the Fed doesn't need to cut as much as it thought maybe a month ago,
Yeah.
and that makes some sense with the stronger, with good economic data.
Yeah, and we'll get another dot plot, right? The last dot plot we got is a little bit out of sync with what the Fed funds tool is suggesting for this terminal rate, but we can get into that. I know you sent me some good data on some of these slides that you sent over. Let's take a peek. Number one.
Oh, well, if
See,
you're
see,
showing the
yeah,
inflation chart,
yeah,
this is the headline CPI, but that's the one we all pay.
yeah.
And we're below 3%. The core inflation, the PCE that the Fed looks at, that's also below 3%. We're not at 2, but we've made tremendous progress. And, the Fed doesn't need to worry as much about future inflation right now anyway.
But you think the core is like a little sticky around 2.7, 2.8?
Of course, that's services are running a little bit above 4%. Goods are running closer to 0, and shelter is running at still closer to 5. So, you have to average all these things, but the average is still below 3. But certainly the services are a little more sticky.
Yeah. And you mentioned shelter. I mean, the conventional 30-year mortgage, as estimated by the Mortgage Brokers Association, has actually gone up about 30 basis points over the last 2 weeks. So that's not trending in the right direction either.
Well, that's the sell-off in the 10-year Treasury. That's the benchmark for
Okay.
that, setting those rates. And, and that's if you get a stronger equity market and you're comfortable about the economy not going into recession, then a, 4.25, 4.5 10-year yield makes a lot of sense.
Yeah. Well, right. But is that yield kind of up, like a little bit peaking up right now because of government borrowing or inflation concerns or even just political uncertainty, right? Investors might want a higher yield going into the transition.
I would argue that the 10-year is really reflecting the no landing scenario.
Okay.
2% GNP, 2.5% inflation. You add those two together, you get 4.5. And hey, that's probably the band 4 to 4.5 on the 10-year.
Got it. All right, let's keep rolling here. New weekly unemployment claims. Yeah, so let's talk about we had that data yesterday. 220, I think 221K was the headline number, and then continuous jobless claims seem to be kind of a little bit higher than we were comfortable with.
I don't know. First of all, this is the new claims. You can see the little zigzag there a couple of weeks ago. That's the hurricanes, and that's gone away. If you
Okay.
turn to the next chart, you'll see the continuing claims. And, they're edging up, but the non-seasonally adjusted ones are still very low. So there's no issue. The unemployment claims are saying everything's okay right now.
Okay, well, that's good to know. I mean, it seems like just my gut feeling is that employers are keeping their folks, right? They've accumulated all of these folks post COVID. Some didn't accumulate. Some got rid of some of them, but they're kind of happy with the workforce and maybe not expanding, maybe not contracting. That's the feel I have.
That's right. And by the way, it's very expensive to let somebody go and then hire them back a year later. You're way better off sucking it up and keeping them. And the economy is fine. It's not growing as fast as it might have, but we're at least at a 2% GDP economy. We may be even a little higher. And you don't want to lay off workers and then have to hire them back. That is a very expensive move for corporations.
Yeah, no, that makes sense for sure. But that 2% GDP, how do we compare with the other industrialized countries?
Well, we're better than Europe. On a statistical basis, we're not better than China, but if you kind of adjust their numbers to reality, we probably are. And, we compare very well with most emerging market countries. Some of them, like India and others that have very high labor force growth, are growing a little better. But the U.S. is a solid performer around the world.
Yeah. All right. That's the sense that I have also. Let's keep rolling here. Let's go to the Fed funds rate expectations as of November 7th.
Yeah, you can't quite see it on this, but the terminal rate is 3.75 to 4%. The red lines are all the FOMC meetings, but if you're going to go down a little, let's say a softer slope, then you're
Hmm.
going to skip some meetings as we go into next year.
Well, the softer slope seems to reflect reality a little bit better than the dramatic Fed Fund Watch Tool numbers we were getting, just 6 months ago.
Yeah, go to the next slide, which shows the end of 25 expectations. Here you see that, like you were just saying, back in September, October, the market was thinking, wow, we could go to 3% or just a little below by the end of 2025. And now we're in that 3.75 to 4% territory. I mean, we're like the Fed, we're all a little data dependent, but if the economy can avoid a recession and inflation can stick around 2.5, that makes a lot of sense.
Yeah, and I can't help but going back to the September dot plot. right, which was a little bit more aggressive to the downside from a median point of view. I think it might have been 50 basis points lower than actually we're at right now.
That's right. The Fed talks about being data dependent. I think they're a little too data dependent because they'll talk to you about not responding to one data point, but in fact, if you look at what they do, it's not quite so clear. But we're gonna like even out here, and we'll just see where we go.
Yeah. All right. All right. We're talking about Treasury yield curve right now. Yeah. I mean, I'm surprised. I'll be honest with you. I'm surprised, especially the 30-year and now the 10-year. The big sell-off in the bond prices kind of surprised me. A couple of days ago, though, we had a decent 30-year Treasury auction. I mean, relatively decent. I was surprised at that also. So I'm wondering if the bottom's not in on this long end of the curve.
I think, when you have a Treasury auction, everything gets sold. You just don't know the price or the yield,
Right.
because it will all get sold. And,
Yeah, but
yes, go ahead.
I think that, I look at the percent that goes off at the high yield, and I want to say that it was low. I want to say it was about 14, 15% was awarded at the high yield, which is good for the Treasury Department, right?
Yeah, I mean, again, the treasuries, they went up and kind of got a little close to 4.5. Now they're coming back to 4.3, give or take. That's a pretty comfortable range for a no landing economy.
And so just to define low, I mean, we were talking about in terms of soft landing for, I don't know, 24 months, maybe longer. Are we going to have a soft landing? Are we going to have a soft landing? What does no landing mean with respect to soft landing?
No landing is 2% real GDP. Soft landing is an ambiguous term because I don't know about you, but when the plane lands, it eventually stops. And I think that was just not a good analogy. So we're now like hard landing and no landing, I think. Soft landing has faded away.
Yeah, well, that's a good analogy. By the way, Tom Schneider's a pilot. He actually was in at the Breeders' Cup in California and got to fly in a small plane with his brother. He sent some pictures. It was awesome. So good analogy there. Okay, so 10-year notes is the thing to look at, right? I think on the next, I think you have that yield, the spread on the next page. No.
Yeah, and I've I highlighted the distance between 3.5 and 4.5.
Yeah.
Three
Okay.
and a half is really, it's not an economy in recession. Recession would be below 3.5.
Okay.
But it is responding to the idea that inflation is more or less under control. Hasn't hit the Fed target, but it's not going back up. And the economy is slower than the post-pandemic job surge, but it's okay too. And that puts you somewhere in this fairly wide range.
Okay. I got it. I mean, from a charting point of view, I like this, right? From a charting point of view, it's like overbought, oversold, almost like an oscillator on this chart.
Yeah, and you can see, and we went up. We got close to 4.5, and we're coming back down a little
Yeah.
bit, and we'll just see
Yeah.
where we go. But you don't get to 3.5 unless you're really worried about something not so good happening.
Okay, and then that's going to change. If that's the case, that changes everything, including uh, Fed funds expectations for the next year or two.
Oh, absolutely. The Fed's made it clear that if we go into a recession, they'll respond with significantly lower rates. I don't think they'll go to 0, but they might very well go to 2 to 2.5. But that's only if we have a recession, and the data don't show that right now.
So do you think, there's some folks out there like Mohammed Al-Arian suggesting, well, the Fed made a mistake cutting 50 the first time. They sent the wrong message. They panicked a little bit. Do you feel the same way?
No. Of course, I didn't go to Oxford or Cambridge. I went to Tulane, we're a party school, but I think I learned a lot down there about jazz, finance, everything. Anyway, I really don't think the 50 basis points was a mistake. I think it was they were admitting that they should have gone in July and they just caught up. And they told us really clearly in the press conference that the 50 was not going to happen again. So I disagree on that one. I think it was okay to go 50. We're still, look, if inflation is 2.5 and Fed funds should be 3.75, 4%. They should be lower. We're a little too restrictive right now. So they've got, they want to go slow. I get that, but they've got room to cut a few more times.
Okay, so that spread between the two are about 150 basis points in your mind would be ideal.
Yeah, I mean, we're obviously talking conjecture here, but if longer term inflation expectations are anchored around 2.5 to 3, then I would be comfortable with a Fed funds rate of 3.5 or so, or 3.5 to 4. I want to be 1% or so higher than the prevailing inflation rate, and that's where I think the neutral Fed funds policy is. That is the policy that doesn't stimulate and isn't restrictive. And I would prefer them to go there right away and say, wow, boom, we're there and we're not moving now.
Okay.
But the Fed never will do that. They're gradualists.
Baby steps. Well, yeah, and nobody in the world believes that 2% is the neutral rate.
No,
as far as I could tell.
Exactly. 2% is accommodative.
Yeah. So anyway, all right. So that 50% then's in line, right? And another 50% yesterday would have been in line with that, getting that spread closer.
Well, it would have been lying and getting it closer. But again, communications, the Fed prefers to take the stairs down. They, even if they know where they want to go, they just don't want to go there tomorrow or today.
Yeah.
I get that. I mean, I'm not, and I don't think it makes very much difference whether they get there yesterday or March, but that's where they're headed. They're headed to about 3.75 to 4%. And then if the data changes, well, that'll change too, but we'll see.
Yeah. So that's in line with again the CME's FedWatch tool suggesting still we have a 71% chance we're going to get another 25 basis point cut in December.
Yeah, I think we will get the next 25 in December. After that, it's data dependent for sure and policy dependent. We really don't know what how aggressive we're going to be on tax cuts and on tariffs, but policies are changing and the Fed needs to wait and see.
Yeah, right. And I think some of those cuts are going to expire. So there's going to have to be some action on whether they reinstate them or not, or add new ones.
Yes, the tax cuts that were initiated in the first Trump administration will expire in 2026. They have to be renewed in 2025. With a Republican Senate and a closely divided House, probably a Republican House, they're going to renew them, but it will be a debate.
Yeah.
We have to fund the government by December 15. That's with a lame duck Congress.
Mm-hmm.
That'll be an interesting debate. The debt ceiling goes back into place on January 1st at the new level of debt, 35 trillion, give or take. That means that we hit the debt ceiling without, the emergency measures that the new Treasury Secretary will have to use will run out in June or July. But the Senate has always wanted to avoid a debt ceiling crisis. So there'll be a lot of attention on the House because it's so closely divided.
Yeah, but some of this, I mean, they'll have to kick the can down the road a little bit this calendar year, right?
Oh, they're going to have to kick the can down the road before December 15th, but I think they're all ready to kick the can.
Okay. Okay. Sounds good. I think we have a couple more slides here to talk about. We have an equity indices comparison for 2024.
Yeah, you can really just see, we had a pretty a big rally during the election and post-election. That's all about tax cuts, corporate tax cuts.
Okay.
So that's not just the tax cuts being extended, but the corporate tax cut, the corporate tax rate possibly being lowered again a little bit. So corporate tax rates, if you lower corporate tax rates, that helps all companies. By the way, it doesn't help the economy at all. They use that money to buy back shares, do all kind of things, but not investment. So it's not going to help the economy, but it certainly helps equities.
Well, so and also you're going to take some money out of the Treasury's pocket, right? It'll be less there to pay for more spending.
And that'll be the interesting budget debate because if you're analyzing economic activity, the budget deficit, surprisingly enough, doesn't matter very much. The budget deficit determines what's the new supply of Treasury. So, if the budget deficit's going to be bigger, that's more Treasury. So you got to be cautious on buying Treasury. But what really matters for the real economy is government spending. Is it going to speed up or slow down? If it slows down, then the real economy might slow down. The government's a pretty important part of the real economy. And that's what we'll just have to see how much restrictive or constraining nature comes to government spending. But I think we're going to see some of that in 2025.
So I think Powell said something to the effect yesterday that the fiscal path of the U.S. is not sustainable. I mean, that was a bold statement.
Yeah, and it's a statement the Fed chairs don't like to make, but what he's talking about is the total level of debt.
Okay.
The fastest growing part of the budget deficit is interest expense. That's going to continue to grow. The government debt will continue to grow. There'll be a debt ceiling debate, if you will, in the summer of next year. And if you extend that 5-10 years, it just doesn't work. But it can certainly work for next year. It's not a current crisis, but it's a long-term one, and the Fed pointed that out.
So, but does the Fed then get some political pressure to cut rates because the Treasury Department says, "Hey, we want our debt service. We want to kind of bring down our debt service a little bit. Let's bring these interest rates down."
Well, you're harking back to what President Truman wanted in 1952. He wanted the Treasury to control the interest rates so they could be near zero, so he could fund all the debt from the Korean War and everything else. That's a typical presidential position. And that's why we have an independent Fed. So this is going to be a very interesting debate about, but currently the Fed as it's composed is likely to lower rates, but only in line with inflation, not to fund the debt. That's not what they're supposed to do. They're supposed to price stability and full employment are their goals.
Yep.
Funding the
Yep.
debt is the Treasury's problem.
Yeah. So going back to the chart on the screen here, me and Tom talk a lot about this, about perhaps the Russell 2000 small cap companies might have a better advantage as interest rates are cut because they're probably more sensitive to borrowing.
That's partly true, but I would argue that the Russell 2000, on the day after the election, the Russell 2000 was up over 5%. The other equities were up 2 to 3%. To me, that was tariffs. Everybody's up based on corporate taxes being cut, but Russell 2000 are mostly smaller domestic companies. They're not big international operations. So if you're going to raise tariffs, those are the companies that will be protected more. The big multinationals, it just cuts both ways. Sure, their U.S. operations are helped, but their international operations might get killed because if the U.S. raises taxes, there's going to be a tit for tat. It's not going to be pretty. And so our multinationals, you don't know where they're going. So Russell 2000 benefits from corporate taxes like everybody else, but it also benefits from the potential of higher tariffs.
So, okay, so the big criticism as well, higher tariffs is going to refuel inflation. Is that a given?
That's not a given. In the long run, if you were in a high tariff world for 20 years compared to a low tariff world, you'd probably have more inflation. Okay, and that's what economists do. They analyze, okay, what's normal and what's the new normal, and but I'm a little different. I want to know how you get from A to B. And a shift from low tariffs to high tariffs with a lot of tit for tat, reciprocal tariffs, things like that going on around the world, That's very disruptive to supply chains. It's very disruptive to global growth. So in the short term might only be 2 years. Let's not get carried away here. But it's definitely, to me, it's recessionary in the short term and inflationary in the long term. So I distinguish between, how you analyze the disruptive nature of moving to higher tariffs versus how you analyze, okay, we're there. What does it mean if we stay there for 10 years?
Yeah, and from a longer term point of view, would that spur domestic production and innovation? In other words, all right, it's too expensive to import this stuff. Let's start making it here.
No, it spurs domestic profits. Companies that are protected are not particularly innovative. They don't invest more. They pay their shareholders more. And of course, they raise prices because they can. Because they don't face the international competition. So the consumer ends up paying and the stockholder ends up benefiting, but you do not get more innovation with tariffs.
Got it. Okay, so that makes sense. And by the way, about 3 weeks ago, maybe, I think I noticed that the European community imposed tariffs on China's EV vehicles. And I didn't maybe because I'm in the U.S. instead of Europe, but I didn't hear a big outcry then.
Well, you didn't, because let's zero in on Germany here. They're the big auto producer in Europe. I mean, France produces some, but it's the German brands that are king. And listen, they're hurting.
Yeah.
And the European community said, hey, we're going to provide some protection for you.
Yeah. Okay. Well, they did it. By the way, I was just in Sicily, Blu. Everybody just about has a Fiat. It's like driving a big refrigerator, maybe.
Even the Pope has a little Fiat.
Yeah. The Pope Mobile. Awesome.
Yeah.
Yeah. Anyway, Blu, thank you so much for your time and your information today. It was great, as usual, catching up with you. Hope to talk to you again sooner than later.
Sounds good to me. Thanks so much.
The following presentation is for educational purposes only. All the symbols, trading ideas, and market commentary are for educational and demonstrational purposes only and are not recommendations or trading advice. Live sample trading occurs in a simulated environment. Past performance may not be indicative of future results. All the information and content presented is provided by NinjaTrader LLC, and the opinions expressed by all third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.